the most important thing, uncommon sense for the thoughtful investor. Howard Marks isn't just dishing out playbook here. Instead, he shares an insightful philosophy designed to help us understand the markets, navigate risk, and avoid common investing pitfalls. This book isn't about beating the market every time. It's about gaining an uncommon perspective on investment, what Marx called second level thinking. So let's dive into what that means and how it can change the way you think about investing. Marx starts with the basics. Investing means buying assets you believe will grow in value. But in Marx's view, successful investing goes deeper. It's about spotting assets that are mispriced, assets whose current price is below their intrinsic value. The challenge is mispricings are rare because the market constantly assesses assets based on available information. When mispricings do occur, like Yahoo's infamous plunge from $237 to $11, it's due to disconnect between assets price and its true worth. So, if spotting mispriced assets is key, Marx argue you need to have second level thinking. First level thinking says this company is solid, I will buy. Second level thinking asks, if everyone else thinks it's solid, is it actually overpriced? By recognizing and questioning market sentiment, you can identify those rare opportunities and also where assets deviate from their intrinsic value. Speaking of value, Marx emphasizes that intrinsic value is the cornerstone of smart investing. The rule is simple: buy low, sell high. Yet this is often easier to said than done, especially since the market can be widely influenced by non-rational factors like mass fear or greed. To make wise investments decisions, you need to differentiate between what something actually worth and what some people think it's worth. This is where fundamental analysis of a company comes into play. Look at its ability to generate profit, repay debts, and overall economic health. By doing so, you can spot assets that are priced below their intrinsic value and capitalize on them. But there is more to equation than just value. Howard Marks introduces two key elements. These are psychology and technicals. Both of these can distort price. During a market crash, for instance, fear often causes people to sell off assets at the loss simply to avoid further damage. Similarly, technical factors like rapid sell-off can drive prices down without reflecting the asset's true value. The lesson here is always look beyond current price, factoring in psychology and technicals to gauge where the asset's true value lies. Another critical concept is that Howard Marks addresses is risk. Investing involves inherently dealing with the unknown. You can't predict the future, but you can be smart about assessing risk. Marx points out that some of the riskiest investments are those where people believe there is a little or no risk. High prices can create this illusion. High prices leading people to think that these things will continue to go up forever. And when optimism overrides caution, you are in a dangerous territory. Then the power of cycles. Howard Marks highlight how markets are driven by human emotion, leading to cyclical behavior, periods of prosperity followed by times of hardship. This isn't a one-off cycle, it's a constant push and pull influenced by human nature. Recognizing these cycles allows investors to prepare for the lows for when others are overconfidently riding the highs. And Howard Marks' advice here is take the advantage of cycle by going against the grain. When market crashes, find those who are desperate to sell and buy. When the market is soaring, consider selling before things turn. What's more is the Howard Marks cautious against the following the crowd. He argues that best opportunities arise when everyone else look or fears on an asset. And so if you are searching for a great investment, look at those assets that are undervalued, even disliked by majority. Thank you very much for watching this video till the end.